As of 2:12 p.m. Eastern Time, shares of Figma, trading on the NYSE under the ticker symbol FIG, are priced at $56.96, marking a significant intraday surge of $3.92, which translates to a 7.39% gain for the session. Now, many investors might see that powerful green candle and immediately think the story here is purely about post-IPO momentum and the market's insatiable appetite for high-growth tech darlings. The expectation is that Figma, having recently made its public debut after the highly publicized, now terminated acquisition deal with Adobe, is simply riding a wave of speculative enthusiasm. This narrative suggests it's a straightforward growth play, a classic case of a dominant software-as-a-service company finally hitting the open market and capturing the pent-up demand. But the reality of today's 7% jump is far more nuanced and reveals a critical pivot in how the market perceives not just Figma, but the entire creative software landscape. This isn't just about a hot IPO, it's about the market recalibrating Figma's valuation in a world where it remains an independent and formidable competitor, rather than a mere subsidiary of an industry giant. The failed Adobe deal, once seen as a potential setback, is now being interpreted as Figma's greatest strength, allowing it to innovate without restraint and aggressively capture market share from the very company that tried to acquire it. The common belief floating around trading desks and online forums is that Figma's success is tethered to the broader health of the tech sector, making it susceptible to the same macroeconomic headwinds that buffet names like Tesla stock or Nvidia stock. The assumption is that rising interest rates or a slowdown in enterprise spending will inevitably clip Figma's wings. However, a deeper look at the on-chain data and institutional flows tells a different story. The reality is that Figma is exhibiting signs of becoming a defensive staple within the tech world. Its collaborative design platform is so deeply integrated into the workflows of major corporations that it's treated less like a discretionary software purchase and more like a utility, as essential as electricity for product development teams. While other software companies see budgets slashed, Figma's contracts are often the last to be touched because the cost of ripping it out and retraining entire departments is prohibitively high. This stickiness is something the market is only just beginning to price in correctly, and it fundamentally challenges the expectation that Figma is just another high-beta tech stock. Many retail investors using platforms like Robinhood or SoFi Invest might be trading it based on sentiment, but the serious capital flowing through channels like Fidelity Wealth Management and Interactive Brokers is betting on its entrenched utility-like status. Today's trading activity is particularly telling. Volume has surged to over 28 million shares, significantly above its daily average. This isn't just retail excitement. This level of volume indicates substantial block trades, a clear sign of institutional accumulation. Major funds are building positions, not just taking a flyer. This heavy volume adds a layer of validation to the upward price movement, suggesting it's backed by conviction, not just fleeting interest. We're seeing a pattern similar to the early days of other transformative software platforms where institutional players quietly build their stakes before the broader market catches on. This is where diligent self-investing pays off, recognizing that the real story isn't just the price change, but the volume and character of the buying behind it. The expectation is a volatile new stock, but the reality is a methodical acquisition of shares by major players who see a long-term compounder. Tools like Schwab Intelligent Portfolios are likely already adjusting their algorithms to increase exposure to FIG based on these very metrics, recognizing its potential to become a core holding alongside giants like Apple stock. To understand the conviction behind this move, we need to briefly touch upon what Figma actually does. Figma provides a web-based collaborative platform for interface design. Before Figma, designers would create mock-ups in isolated desktop applications, email files back and forth, and struggled with version control. It was inefficient and siloed. Figma changed that by creating a single, live environment where designers, developers, and project managers can all work on the same file simultaneously. It streamlined the entire product development lifecycle, from initial brainstorming to creating interactive prototypes. This isn't just a nice-to-have tool. For many tech companies, it is the central nervous system of their design and development operations. Its business model is primarily a subscription service, with tiered pricing for individuals, teams, and large enterprises, creating a highly predictable and recurring revenue stream. The recent earnings report underscored this, showing a 40% year-over-year revenue growth and, more importantly, a dollar-based net retention rate exceeding 140%. This means that not only is Figma keeping its customers, but existing customers are spending over 40% more on average than they did the previous year, a testament to the platform's expanding value within organizations. This brings us to the future outlook, where the tension between expectation and reality becomes even more pronounced. The expectation is that Figma now faces a brutal head-to-head battle with an emboldened Adobe, which will pour resources into its own competing product, Adobe XD. The market anticipates a price war, margin compression, and a long, drawn-out struggle for dominance. However, the reality is that Figma's primary growth catalyst may not even be in direct competition with Adobe's core design tools anymore. The company is rapidly expanding into adjacent markets with products like FigJam, a collaborative online whiteboard that competes with Miro, and by pushing further down the development pipeline with tools that translate designs directly into code. The true opportunity lies in becoming the all-encompassing platform for digital creation, from the first sketch to the final product launch. Furthermore, the integration of artificial intelligence into its platform is a massive potential driver. Imagine AI-powered tools that can suggest design improvements, automate repetitive tasks, or even generate entire user interfaces from a simple text prompt. This is the future Figma is building, one where it isn't just a design tool, but the operating system for product teams. This strategic expansion is a key reason why sophisticated online investment platforms are flagging the stock as having a much larger total addressable market than initially perceived. Comment below what you think Figma's next big product category will be. Of course, risks remain. The biggest is valuation. Trading at a high price-to-sales multiple, Figma stock is priced for near-perfect execution. Any slowdown in growth, any sign that its expansion into new markets is faltering, could lead to a sharp correction. The company also faces the perpetual risk of disruption from a new startup that devises an even better way to facilitate collaborative design. While its network effects provide a strong moat, the tech landscape is unforgiving. Investors using platforms like Fidelity Brokerage or Interactive Brokers need to be mindful of these risks and not get carried away by the current euphoria. A diversified approach, perhaps through Fidelity ETFs or a managed individual brokerage account, can help mitigate the risks associated with any single high-growth name. In summary, the story of Figma stock today is a powerful lesson in looking beyond the surface-level narrative. The expectation was that of a newly public tech company riding a wave of market sentiment after a failed merger. The reality is far more compelling. We are witnessing the market's awakening to Figma's new identity as a fiercely independent market leader with a utility-like grip on its enterprise customers, expanding into new verticals and backed by significant institutional conviction. The 7% intraday jump isn't the culmination of its story. It's the market repricing the stock for a future that is much bigger and more promising than what was envisioned under the shadow of a corporate acquisition. The failed deal didn't close a door. It opened a gateway to a much larger kingdom. If you found this helpful, don't forget to like, thumbs up, and comment your thoughts. Let's discuss. Disclaimer: this is not financial advice. Please do your own research before making any investment decisions. Trading involves risk, and you could lose money.